My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to make a little money. My job is not just to entertain, but to educate, coach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. What, are we out of money? Don't the mutual funds have enough cash? Hey, that's my reaction to this action. After a day when the Dow advanced 65 points, S&P dipped 0.32%, but the Nasdaq lost 0.85%. With the latter becoming an annoying source of funds for everything else. Right now, at this very moment, mutual funds know that they have to pivot out of the consistent growth stocks, especially tech stocks like software and semis that don't benefit from the rate cuts. They have to then swap into the companies that can supercharge their earnings as the Fed takes rates lower. We all recognize that the cyclical stocks, the ones that benefit from lower interest rates, can go higher, maybe much higher. What's painful for many of you are the declines in stocks of companies with consistent earnings.
The house of pain.
The companies that don't really need lower rates, the tech companies in particular. They're selling off as though money managers need to raise capital in order to rotate into the rate cut winners. So why don't we do this? Let's go over the winners and talk about the losers. The rate cut winners are divided into two camps, the stocks with high dividend yields and the cyclical companies with earnings that should go higher because lower rates will bolster all sorts of industries, especially housing. Let's start with the most direct beneficiaries. Let's start with housing. They were all down today, and I think that's because the hedge funds and mutual funds bought these stocks aggressively ahead of Friday's Jackson Hole verdict. The mutual funds are staying long. That's what they do. But the hedge funds, they are ringing the register furiously. I mean, they're going crazy because they've made so much money. The housing stocks have had parabolic moves going to the Fed confab at Jackson Hole. So now these portfolio managers are just taking the profits. By the way, that's what you're supposed to do for a successful trade if you are a trader. Remember, these guys were always traders, not investors. So the housing trade's over, but how about the housing investment? Look, I believe the Toll Brothers, which just reported a stellar quarter last week, can go higher, maybe much higher. But this reversal is going to constrain the stock because people do not like these technical trends that we just saw. We've seen multiple long-term reversals after these kinds of moves, and they rarely turn out to be buyable, even though in theory this should be a great moment for the stock of all the home builders. It doesn't matter, though. This kind of reversal that I'm talking about in Toll or D.R. Horton, Lennar, they can be hideous. Some are very close to their highs. I don't like that. Those who have these, well, you can hold them, but they flew too close to the sun for getting new buyers in. Remember, I've said all along that by the time the Fed gives the all clear, it may be too late to buy the most obvious rate cut winners. You have to let them recharge, let them come down, and then you can pull the trigger. Then there, of course, there are the ancillary plays. There's Home Depot and everything that goes in one. Every single aisle of Home Depot could be a buy. Home Depot itself is a stock we're considering for the Charitable Trust, which you can follow by joining the CNBC Investing Club. Sometimes you can't overthink things. When you're on the quarterly Home Depot conference call, it's largely devoted to the damper that high rates have put on sales. It was really kind of a bummer, frankly. Then you know that the interest rate headwind is about to turn into a tailwind, and you have to be a buyer. Hence our desire to pick up some for the trust. Lowe's is in the same boat. I like them both very much now that we're going to be sure that the Fed is going to cut. I like them as much as I didn't like them 2 weeks ago when it looked like the Fed might not. Now, some stocks have had such mammoth runs that you don't want to have your money languish. Sherwin-Williams, good example. The paint company is recommended almost every day. This one is due for a pullback. We own Stanley Black & Decker for the trust, and it's been a bit of a coiled spring. That said, it's had a nice run from the bottom, and its yield is just 3 and change, much lower than where it was before, like when the rally got going. I mean, what can I say? We sold a little. I think it can go higher, or we would have sold it all. Warehouse is a much easier call. Its stock seems very unloved here at $31, even as will desperately need their lumber if the rate cuts come fast and furious. Please do not forget a company we showed you last week. That's Fortune Brands Innovations. This maker of highest-end faucets and housing accoutrements, including decking and safety, can really benefit from lower rates, even as it's done a lot of self-help to thrive in a high-rate environment. I really like that shut-off device that they can prevent flooding when you're away. Insurers are embracing the concept, giving you lower homeowners premiums if you buy these setups. They pay for themselves. If you get a serious run in housing, then Master Brand, formerly part of Fortune Brands, could really be good. It's a maker of cabinets. We've used the Aristocrat cabinets. They're fine. But my favorite in this group may be AZEK. Yes, the faux wood products company. That's fantastic as a replacement for wood decking and trim. I put a ASIC in the moment I buy a house because I'm tired of having to fix a wooden deck 2 or 3 times. Real wood is a money pit. In a few years, you just don't even realize how much of a difference you can save. ASIC has leaned into recycling, and it's a big percentage of it is materials that are 90% recycled. By the way, I think Owens Corning has great fiberglass for housing. That's pulled back a little. One of my favorites, though, is DuPont, double D, which is splitting into 3 companies, of which one, classic DuPont, has Tyvek, the obvious housing play. The trust owns it, and I think it could rally much further, especially if it gets bids for its water division, which is technically for sale. The more attenuated plays are going to work too. Caterpillar, you saw that up today. Martin Marietta Materials represent the basics of building out new housing developments. But those really start winning later on, once the home builders fully embrace new construction. Oh, and one more that's not for the squeamish. Whirlpool, serial disappointer that may or may not be able to bottom. We might need a raft of cuts to boost that one. I put Williams-Sonoma and Wafer in the same category, but they just reported, and they didn't give me much to hang my hat on. RH, the old Restoration Hardware, it isn't much different. A lot of things have to go right to get that one moving. Those are the most straightforward potential winners, but the other side of the rate cut is to search for stocks with larger yields that can become bond market alternatives as rates come down. Buyers are already embracing Johnson & Johnson, which has the added advantage of a weak dollar. Dollar's been very weak, so it's twice blessed. Kimberly-Clark, again, failed to beat the estimates, so it's stalled. But I think it's just a matter of time. I also like the oil and gas pipelines. More on those later. Now, how about the other side of the trade, the sources of funds? This one's really tricky because right now the best are being thrown out with the worst. The semis are horrendous. I am gratified Nvidia is coming down ahead of earnings on Wednesday, though. It needs to pull back here if you want to see it rally on results. I like Amazon, the possibility of knowing exactly what you want before you even thought of it. That's the next frontier. If Amazon can find a way to batch every same day's purchase, I think it can save a fortune. Meta, it's killing it, but its stock is down 23 points from its high. I like that. I like AMD. It's a worthy second Nvidia, but it's not going to. The stock's really, really tough sledding here. Micron's down a great deal. There's plenty of need for high bandwidth memory. All of tech is for sale. Apple now is for sale because its fabulous CFO, Luca Maestri, is going to be stepping down, but he's going to stay for a while, so let's not panic, please. But the bottom line, I want to keep the buy list small because I think there'll be many more days like this to come. There's just not enough money raised so far to think the tech is bottomed. The sales are not covering the buys. At this point, there's going to be a lot more NASDAQ weakness. So please be ready to do some buying, but just not yet. Too early in the rotation. I want to go to Thomas in Wisconsin. Thomas.
Hey there, Jim. Always appreciative of your insights and your preparation.
Oh, you're very kind, Thomas. Very kind.
Oh, you're great. Back in 2019, before the pandemic, I was introduced to Moderna through your show and bought it at about $20 per share. I've sold most of my position off when it was higher, but now it's less than 1/5 of its all-time high and down over 25% year to date. Is this a buying opportunity, or should I give it more time?
What a tough call. I've got to tell you that it keeps. Let's put it this way. It's not delivering what I expected at this point would be personal cancer vaccines. I think you can still fall some because it's not making any money. That's my take. Let's go to Har in Virginia. Har.
Hi, Jim. How are you doing? Thank you for your time.
I'm doing well. Thank you. Thank you. How are you doing?
I'm good, thank you. Thank you for all you do for us to teach us about investing.
Terrific.
My question was about ZM, Zoom Video Communications, who just reported earnings. It wasn't too bad of a report, in my opinion. The company's balance sheet looks pretty clean, no long-term debt. 30% of the market cap is cash and marketable securities. For the fiscal first half of 2025, they are reporting a free cash flow of $925 million. The revenue growth was 2%, unlike the pandemic time. But the enterprise client contributing to more than $100,000 grew by 7%. And it's trading at a fairly cheap valuation, in my opinion, with 8 times forward.
Boy, are you ever right, Har. You are right. I liked the quarter. I thought it was a good one. I like this. There are many, let's say, accoutrements are starting to work for Zoom. So a lot of things that they develop, including some of the apps. I think it's a good buy here. Now, it just had a parabolic move off the bottom. Straight line. It can measure. It can probably, churn a little bit here. But I agree with you. I think Zoom's really interesting. This was a very good quarter. How about Faluk in New Jersey? Faluk.
Hi, Jim. How are you doing?
I am doing well. How about you?
I'm doing good. Thank you. This is Falak from New Jersey. I've been following your show for many years, and I really appreciate all the effort you put into helping people make informed investment decisions. Thank you so much for that.
Oh, thank you.
My question is about Uber. They had great results last quarter, and the stock spikes up afterward. Given Uber's market cap and the current market turmoil, should I consider entering now, or would it be wiser to wait for a pullback?
No, I actually buy some Uber here and then wait for a little bit of a pullback. Uber's doing incredibly well. You may not get that pullback, so I want you to get some on the sheets as we talk about it. It is up a lot this month, so let's be careful and only buy some, not all. And thanks for the kind words. Okay, look, there's going to be more NASDAQ weakness, especially when rates start coming down. People keep shifting the money toward the groups I just told you. So you have to be ready to do some buying, but not yet. On My Money tonight, after its bullseye quarter last week, can we officially declare a turnaround in Target? I'm breaking down the numbers behind the retailers report and telling you where I stand. Then from energy to real estate, I'm laying out some high yielders that you may want to add to your watch list. Plus, could cooling interest rates open the window for HVAC stocks to heat up? I'll reveal my picks, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
After last week's incredible results, Target's cooling back, and maybe it's better than it's been in years. Keep in mind, last October, the stock was at the tail end of a brutal 2-year collapse. That took it down 62% from peak to trough. Target seemed lost, maybe even broken. It was just one problem after another. First, the stock pulled back from its COVID-era highs, given how much this essential retailer had rallied during the pandemic. Then in 2022, when the world went back to normal and consumers changed their shopping habits, Target was caught flat-footed, having double-ordered lots of the wrong inventory. Then they had to discount that stuff heavily to get it off the floor, which led to a severe earnings hit. Plus, like virtually everyone else in retail, they had to contend with high levels of theft. But I've always been a believer in CEO Brian Cornell's ability to turn things around, and he started truly turning things around last November. In fact, from its lows last October to its highs on April 1st, Target rallied almost 77%. Even then, though, the company wasn't truly reporting good quarters. It was giving you better than feared results that surprised to the upside. Plus, the stock peaked in April, and from there through early this month, the darn thing was a slaughterhouse. Wall Street got very worried about lower-income consumers, and it didn't help that Target reported an earnings miss in May, with management issuing tepid guidance for the next quarter. After one final leg lower during this meltdown early this month, the stock finally found a bottom in the low 130s, down 27% from its peak in April 1st, also down 7% for the year. At that point, Wall Street clearly wasn't willing to give Target the benefit of the doubt. There was a ton of skepticism about this one, even if, like me, you believed in Brian Cornell's ability to turn things around. It certainly didn't feel like a turnaround stock. But when Target reported last Wednesday, the results were so strong that they changed everything, causing the stock to jump 10% in a single session. At this point, I am willing to call it. Target is back. Why? First off, the company delivered 2% same-store sales growth when the analysts were only looking for 1.1%. Now, this was their first quarter of positive comps since the end of 2022. More important, the entirety of that gain came from higher traffic, up 3%. None of it came from pricing. Prices were lower. That matters. At the same time, Target's online business is booming. Digital comparable sales up 8.7%. Their same-day services saw double-digit growth, with drive-up purchases and same-day delivery for loyalty members growing in the mid-teens. Brian really liked that when I spoke with him. That matters because when Target was lost in the wilderness for 2 years, there was a widespread sense that they'd fallen way behind Walmart on the digital front, to say nothing of Amazon. Now, after that quarter, we know that's no longer the case. Now, when these guys reported in May, the big problem was an earnings shortfall courtesy of higher costs. This time, Target's got its costs under control. Their operating margin came in at 6.4% when Wall Street was only looking for 5.5%. That's up 110 basis points just since Q1. In fact, Target put up its best operating margin number since the fourth quarter of 2021. When you combine the solid revenue growth with strong cost controls, they allowed the company to post a 39-cent earnings beat off a $2.08 basis. Look, that is a 43% earnings growth year over year, and that is spectacular. Of course, it wasn't perfect. Management effectively lowered its full-year same-store sales forecast within the 0 to 2% range, saying that now that they'll likely come in at the lower half. Not ideal, but keep in mind now we're already anticipating 0.1% same-store sales growth for 2024. By comparison, the new forecast is still better. Plus, even when Target revised its earnings forecast, it only did so by 25 cents at the midpoint. Not impressive, given that they just reported a 39-cent beat. As for the outlook for the current quarter, the revenue guidance came in a little light, while their earnings guidance came in a little better than expected. Fortunately, nobody got freaked out by the mixed guidance, in large part because the conference call was so darn positive. After the heinous inventory missteps of 2 years ago, Target clearly feels like it's gotten the right assortment again. I believe it, too. At a time when everyone's worried about discretionary spending, Brian Cornell noted that Target's discretionary category trends improved for the fourth straight quarter, including 3% same-store sales growth in apparel, highly unusual. In fact, their store-owned all-in-motion brand delivered, and I'm going to quote, growth in the low teens. Target's also partnered with Ulta Beauty for their cosmetics store within the store. Beauty's on fire, with 9% same-store sales growth in the quarter they just reported. That's despite coming off some difficult comparisons. How did Target do it? Like every other retailer that's thriving here, they're offering the consumer great value. Over the summer, Target cut prices on about 5,000 frequently purchased items in many markets, especially food, beverages, and essentials. Cornell says that they saw an acceleration in both unit and dollar sales trends in those businesses. By the way, that's similar to what Walmart and Costco saw. Walmart cut prices, and of course, Costco pressured suppliers to lower the prices. Now, there were other highlights, too. Target could deliver such monster margin improvement because they seem to have the theft problem under control. The gross margin saw a 90 basis point benefit from lower inventory shrink. Wow. Which is retail speak for any time merchandise just disappears. We also heard great things about their Target Circle loyalty program, which relaunched in the first quarter. They have over 100 million members, and the company added more than 2 million new people this quarter. But Cornell explained that the real goal with the revamped loyalty program was to increase engagement among existing members. And that's already happening with tons of growth for their Target Circle same-day delivery program, which we know works. We do it a lot at our company. Plus, the loyalty program lets them collect data, give you better, more personalized offers. Again, clearly working, compelling. In the end, this was a really strong quarter from Target in a tough operating environment, easily the best quarter in recent history. Not only were the numbers phenomenal, but there was a feeling that the company's in a much better strategic position. They're finally getting their assortment right and even seeing growth in categories that are supposed to be difficult right now, like apparel and beauty. They're offering customers clear value and it's driving traffic growth. They're winning in digital, making nice progress on the theft issue and reestablishing the loyalty program as a true differentiator. And that's why I think Target's got even more room to run. Even after the big gains last week, the stock still sells for just 16.7 times this year's earnings estimates, which represents a huge discount to Walmart at 31 times earnings or Costco at 55 times earnings. I'm not saying Target deserves the same multiple as those best-of-breed operators, but if they keep reporting numbers like these, then the stock's definitely going to start closing the valuation gap. The bottom line, Brian Cornell and his team have spent years executing a turnaround at Target, and now the comeback is finally kicking in. Even though the stock soared last week, it's way down from its highs. So I'd be a buyer right here, right now. It fits the pattern that I outlined at the very top of the show. Mad Money is back after the break.
Coming up, this segment is brought to you by the number 4. 4%, that is. Yielders you ought to know about. Next.
After Fed Chairman Jay Powell's speech on Friday, we know that interest rates are headed lower. We don't know if the Fed's planning single or double rate cuts. We don't know how many we'll ultimately get. It all depends on the data. But rates are definitely coming down. And as I mentioned at the top of the show, that is good news for high-yielding dividend stocks because they compete directly with the bond market, and lower rates make them more attractive in comparison. Now, I recommended a bunch of high yielders 3 weeks ago, but that was in the context of a miserable market-wide sell-off caused by the implosion of that yen carry trade we talked about. At the time, we were looking for accidental high yielders that had been brought low by the meltdown. I gave you BXP, Bristol Myers, Huntington Bancshares, and Chevron. By the way, BXP is already up 13%. Huntington's rallied 10%. Stocks were in a real hole back then, so the jump back was somewhat natural. This time, though, I want to highlight more stocks with a 4% plus yield. already better than the benchmark 10-year Treasury, which is at 3.8%, and likely headed lower. Specifically, high yielders that work under a softer economy or a stronger one, which is what we'll likely get once the Fed starts cutting. Let me give you three of my favorites. I'm going to start with Kinder Morgan, the energy pipeline play that was a big favorite of mine in that period, say from 2005 to 2010. This whole group tends to have high yields, and the pipeline will operate like toll roads. So they're not particularly levered to the price of oil or gas. Kinder's got some exposure. Really, their plays on domestic energy production growth, which has been happening for the past 2 decades. I very much like Enbridge with its juicy 7% yield, but the Canadian pipeline kingpin is not a part of the S&P 500, so instead we're going to go with Kinder Morgan, which has the 10th best yield in the S&P. That's at 5.37%. While oil and gas prices have pulled back dramatically from their highs in recent months, Kinder Morgan stock has kept on trucking, up more than 21% for the year with very little drama on the way. A lot of that's because Wall Street's been anticipating rate cuts. But make no mistake about it, the fundamentals are solid here. Just a great long-term operator in the pipeline space with a very high yield that's about to get even more attractive as rates come down. Next up, how about Simon Property Group, SPG? It's a mall owner and operator I've been recommending consistently for many years. With the stock currently trading at its highest level since 2021, every time I've told you to buy Simon Property these last couple of years, it's been a good time to buy. And even up here, it still sports a 4.9% yield. This stock is more or less traded sideways from last December until early this month, but it finally broke out of that range with a 13% gain since the company reported an excellent beat and raise quarter on August 5th. Now, for a long time, I've had a two-track thesis for Simon Property. The first part's simple. While many will confidently proclaim that the mall is dead, the reality of the situation is much more nuanced than that. In fact, the high-end malls like the one Simon Properties owns have been doing just fine. When you look at the latest quarter, these guys have a 95.6% occupancy rate, up 90 basis points year over year. That's right, they keep signing more and more tenants. Their domestic property net operating income increased by 4.5% year over year, too. Look, in plain English, that means Simon's malls are full and they're continuing to grow earnings. The second leg of the Simon Properties bull market is a bit more complicated. See, during the pandemic, a joint venture backed by Simon and a partner called Authentic Brands Group bought a bunch of struggling retailers. That did two things. First, they kept those brands in business, keeping Simon's rent base intact as much as possible. But second, many of these investments, including Brooks Brothers, Forever 21, and Aeropostale, turned out to be very lucrative because the Simon-backed joint venture was buying them at fire sale prices. And once we got past COVID, they turned out to be worth a lot more than that. So this turned into a nice little profit center for Simon Property, which the company's starting to monetize in recent quarters, boosting their numbers. There are some other underappreciated growth angles to the story. By the way, like a portfolio of outlet malls in Asia that no one even talks about that are really good. By the way, at this point, Simon's dividend is almost back to where it was before the pandemic forced them to cut their payout. In many respects, the business is the best place it's ever been, which is why I think it's a great dividend stock to own in anticipation of lower interest rates. Finally, I want to give you at least one utility which can work as a safety stock if the Fed cuts fail to juice the economy. But we'll do just fine if the economy improves because we have insane levels of demand for electricity, thanks to, yes, all the data centers we're building to handle the artificial intelligence workload. Many high-quality utilities have yields that are not quite high enough to make this list. Remember, we want stocks that pay better than a 10-year Treasury. The top-yielding utility in the S&P 500 is Dominion Energy, but I'm not sure I trust that dividend. They had a lot of problems. Second, I do like the second highest yielding utility in the S&P, though, which is a company called Evergy, which is, instead of an N, it's a V, Evergy. That's a Kansas City-based company formed by the merger of Great Plains Energy and Westar Energy. This was all the way back in 2018. They're a major player in Kansas and western Missouri. Now, if you look at Evergy's long-term chart, there's not that much to get excited about beyond the current 4.34% yield. Stock's been trading sideways for most of the time since the Great Plains Energy and Westar merger. But when you look into the story, there's one new angle that doesn't seem to be baked into the stock yet. See, 3 major projects have been announced in Evergy's service area that will eventually consume massive quantities of electricity. There's a new $4 billion electric vehicle battery plant from Panasonic. That's one of the largest in the world when it reaches its full capacity in 2026. There's a new $800 million data center from Meta, which should be fully online by 2027. And then there's a $1 billion data center from Google that's expected to be online by 2028. Look at all that growth over the years. Combined, Evergy says these 3 projects represent a staggering 750 megawatts of load. And that's what you should be looking for in a utility stock, a nice yield and the potential for low growth, which is what these projects represent for Evergy. But here's the bottom line. While the averages have been great these past couple of weeks, this is still a trickier market than you might think, as the economy is doing okay at best. And it might take some time for the Fed's rate cuts to really kick things into high gear. But I'm very confident that rates will start coming down next month, which will immediately benefit high-yielding dividend stocks like Kinder Morgan, Simon Property Group, and Evergy. Even if the Fed's rate cuts don't juice the economy, well, they'll make these stocks more attractive versus the bond market competition. I'm going to go to Barry in Florida. Barry.
Booyah, Jim. Second-time caller here. My main question. Thank you. My main question is Cava, C-A-V-A. Good time to get in, good long-term investment.
Not a good time to get in. Great story. Cava is a regional national story that's doing quite well, but it just had a gigantic run and hit its all-time high today at 128. I fear that if I say it's a good time and the stock starts dropping, it could drop like a stone. We got to wait. Or we just have to say, you know what? We missed it for now. Maybe it'll be up later. Get a better chance. 58% increase this month is just too toppy for me. How about Betsy in California? Betsy.
Hey, Jimmy. You told me before I had horse sense. I'm wondering if you feel that way now.
All right.
I am keeping my ANF, my Abercrombie, because they beat 7 out of the last 7 quarters. And I think the key to doing well high end is inventory management. And no one does that better than Fran, Jim. What do you think?
Boy, Betsy, you are so right. Abercrombie reports this week, so we're playing a little bit of Russian roulette there. Reports on the 28th, but I agree with you. I think Abercrombie is just a tremendous operator. Fran Horowitz is a terrific CEO, and I really expect them to do a very good job in the quarter. All right, listen, I do expect rates are going to come down, and soon. So now's a good time to pick up high-yielding stocks, which are only going to get more attractive as the Fed cuts rates. Much more Mad Money, including my deep dive on some HVAC stocks that I think could power your portfolio with a potential rate cut on the horizon. Bye. Then I named my dog Nvidia in 2017. What's happened since? I'm taking a trip down memory lane ahead of the stock's earnings report that everyone is awaiting. And of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Now that we know that the rate cut cavalry is on the way, the Fed Chief Jay Powell almost certainly ordering the charge next month. You need some exposure to the kind of smokestack stocks that can put up tremendous earnings growth once rates start coming down. Specifically, I like the old line industrials that have transformed themselves into entirely new companies by focusing on powerful secular growth stories. I emphasize that because that's what matters, the future, like the rise of the data center, fueled by AI. Or the need to power these data centers by upgrading the, what I would say, frail electric grid. Over the past couple of weeks, I've already highlighted a bunch of these old industrials. We talked about Cummins, Dover, Eaton, Hubbell, Parker Hannifin, Powell Industries. Hey, by the way, Powell's up a cool 12.7% since I added to the mix last Monday, with most of that gain coming last Friday after Fed Chief Jay Powell essentially confirmed that the age of tight monetary policy is coming to an end and the rate cuts should begin next month. Eaton and Dover are in the Travel Trust, and we like them very much for an investment. Lots written about them and talked about if you're a member of the investing club. So tonight, I'm going to give you a couple more industrials that fit the bill. Carrier Global and Trane Technologies. These are both heating, ventilation, and air. I saw your eyes roll. Stop it. These are HVAC companies that I've been recommending for years, and I think they've become even more attractive now that the Fed's getting ready to cut. Well, Carrier's up 440% since it was spun off by the old United Technologies 40 years ago. Much of those gains came in 2020 and 2021, when rates were dramatically lower. During 2022 and part of 2023, Wall Street lost faith in this company, figuring it couldn't work during a slowdown in non-residential construction. A lot of investors also objected to their 12 billion euro acquisition, not dollar, but euro acquisition of Viessmann Climate Solutions. That's the European heat pump business. People thought that was pricey. However, more recently, the stocks have been much better performers as Carrier's core heating, ventilation, air conditioning business proved to be far more durable than most of us expected. The darn thing's up 25% year to date. Now, that's because Carrier's had been chasing growth opportunities in new areas like the data center. It doesn't hurt that they have an excellent CEO in Dave Gitlin, who's done an incredible job ever since this company got spun off from the United Technologies Raytheon deal. This all became obvious when the company reported in late July. While the quarter was really okay and the guidance was mixed, dragged down in part again by that Viessmann acquisition, the stock still took off in the news. Why? Because Carrier told us that it had 30% organic orders growth, driven entirely by their core HVAC segment, which actually had 40 to 45% orders growth. That's a lot. Now, part of that was a big comeback in residential orders, but Carrier also had 40 to 45% growth for commercial HVAC orders in the Americas, with real strength throughout the rest of the globe. Everyone was worried about commercial construction, but as we learned in the conference call, Carrier's won a ton of business from data centers, which need powerful air conditioning to keep their servers cool. They're also doing very well selling climate control systems to schools and healthcare providers. In short, Carrier's only doing fine right now, but investors are piling into the stock because we can clearly see that a big inflection is coming. And that's led primarily by the data center business. Once again, data center being because the machines run so hot. That's what it's about. The stuff inside it is very hot. The stock's traded up to all-time highs, and I can't really tell you that Carrier is cheap here, selling at roughly 25 times this year's earnings. But after hearing those order numbers, let's just say I would not be looking for the exits here. The next few quarters look great thanks to all this data center business. And once the Fed starts cutting rates, the more cyclical parts of the business should really take off. I like Carrier. I have had for a long time, but I particularly like it now that you've got the rate play going for it, not against it. How about Trane Technologies? Okay. This is the other big heating, ventilation, air conditioning play, TT, I call it. In many ways, this is a simpler story. Trane has no big heat pump acquisition. Instead, it's got a great HVAC play. Stock that's up 292% in the last 5 years, including a 44% gain year to date. And Trane deserves these incredible gains. When they reported at the end of July, they delivered a clean beat and raise with 13% organic revenue growth. 13% for an HVAC company? Wall Street was only looking for 8.8%. On top of that, Trane delivered a 22-cent earnings beat off a 308 basis, 23% earnings growth. Trane also raised its full-year forecast for organic revenue, net revenue, and earnings per share, all pretty substantially. But while there was less noise to work through with the Trane quarter, they also had some incredible forward-looking metrics, specifically their bookings and their backlogs. Trane's bookings grew 19% year over year, much faster than revenues, and its backlog now stands at an incredible $7.5 billion. That includes roughly $2.8 billion of commercial HVAC for 2025 and beyond, with $1 billion added to the backlog in the second quarter alone. Management said they've seeing strength in a number of end markets, basically all of them. But they particularly called out, yes, the data center, education, healthcare, and high-tech industrial markets. Very similar to what we heard from Carrier. On the conference call, management said that the company's $7.5 billion backlog is roughly double what they'd expect in normal times. And while CEO David Regnery tried to stress that the strength is broad-based across many of Trane's end markets, he also noted that the orders from the data center are especially nice because they tend to come well in advance and thus give management tons of visibility into how much they can make in the future. If Trane is doing this well now, you can only imagine how well they'll be doing once the Fed starts really cutting the rates. Of course, the stock's had a big run, and now it's pretty expensive. Trane trades at roughly 32 times this year's earnings, much higher than its historical average multiple of 26 times forward earnings. But again, I'm not going to tell you that it's time to start dumping Trane, because business is already going to get stronger as the Fed becomes our best friend. Here's the bottom line. With the Fed poised to start cutting rates, you want classic industrials that are already thriving, but can do explosively better with Jay Powell as it hits the, look, when Jay's accelerating this whole thing. I think Carrier Global and Trane Technologies fit the bill. Carrier's a messier story that's really doing okay right now, but Trane's truly on fire. Even though both stocks seem expensive, I bet they're substantially higher in a few months thanks to the data center demand and the coming rate cuts, and then they won't look all that expensive at all. But you got to get in now to take advantage of that. Their money's back after the break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time. It's time for the lightning round. Coach Benson, Rob Goldman, same as talk about buy, sell, spread, of course, talk about it. Play it, Sam. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Cramer might start with George in New Jersey. George.
How you doing, Jim? Thank you for taking my call.
Of course, George. How can I help?
ELF Cosmetics. I've been a long-term holder, and all of a sudden, I'm losing money.
That one. I put Williams-Sonoma. Well, I'll tell you. Here's the problem with ELF. It is without a doubt one of the most shorted stocks in the market. And every time anything bad happens in the cosmetic group, people come down on it, but then you have to buy. But you don't buy it after the first 14 points down like today. You buy it in a couple of days. Let's wait till Thursday and take a look and see where it is. Let's go to Lisa in Virginia. Lisa.
Hi, Jim.
Hi, Lisa.
Hi, how are you?
Good. How about you?
Good. I'm calling to find out about B&G Foods. Should I sell it?
I don't like B&G Foods. I know it's got that dividend. Maybe it bounces. But the fact is, it's just really a bunch of warmed-over brands put together under one roof. That game doesn't work anymore. It doesn't play here, especially in Mad Money. Josh in Massachusetts. Josh.
Hey, Jim. Booyah.
Booyah, Josh.
I'm looking into a company, Johnson & Johnson. I know this is a market trend where companies are increasingly developing alternative drug delivery methods, such as like oral sprays. J&J recently got approval for Spravato, which is a nasal spray for depression.
Yes, and that's a very, very good drug. That's ketamine. But here's the problem. The stock has just had a major move up. Every time it's had a major move up, it then moves down. It's got a 3% yield. I think people bought it because the yield was a little bit higher. Of course, if the stock goes up, the yield does not stay high. It goes down. I think you should wait until it comes down a little bit. It's too high for me. Let's go to Richard in New York. Richard.
Wow, it's such an honor. And to be able to
thank you for calling, man. Thank you.
You're welcome. To listen to and watch greatness in his prime, Mr. Kramer. Thank you kindly for everything you do.
Thank you.
Anyway, I added to my portfolio recently a stock that's ran up kind of nice, and it has dividends. And the name of the stock is UWMC.
Oh,
and I played
yeah. Look, okay, so UMC, that's Matt Ishbia, and it's time. Maybe its time has finally come. I mean, now it's just moved up to 9. I would wait for a pullback because, again, the stock is straight up. We know a lot of stocks are straight up. We know we don't buy straight up. We say, okay, pass. Otherwise, it's got to come down a little, and that's when I would look at it. Let's go to Chris in South Carolina. Chris.
What's happening, Jim? Booyah.
Booyah to you. What's going on?
Just recently bought a little stock. Warehousing AI stock. Just a little confused about last month. It's dropped about 40% and stuff, but paired with the largest box retailer. Tell me about SYM Symbotic.
No, supply chain management. We don't want to touch this thing. End-to-end AI-powered robot. No one's been able to make that work. The company is not the one you want to be in. It is too high even after this come down. I don't want you to touch it. Let's go to Kay in Rhode Island. Kay.
Hi.
Hi.
Hi. Hi, Kramer. I'm calling. I'm recently a new investor. I'm being showed the ropes by a veteran of the market, Pam, who loves your insight, by the way. But she kind of says I go at it like a youngin'. I kind of buy and sell quickly on the up.
Okay.
So my question is Arcadia a good stock to invest in the long term?
Okay, it's a trading stock. It's not an investment stock. It's central nervous system. The luck in central nervous system drugs is so rare that I can't recommend that stock. It's just too high risk for me. I want to go to Khalid in Georgia. Khalid.
Yeah, hey, booyah, Jim. I'm calling about SoFi.
All right, I am believing that SoFi may be the right one. I think it's just done nothing and nothing. But how many times has Anthony Noto told us, look, it is about to occur if rates come down. So now might be the time. I see the risk reward to be very positive. SoFi. Now let's go to Chad in Wisconsin. Chad.
Hey, thanks for taking my call, Jim. I appreciate it.
Of course.
Hey, so I had to ask the main man himself here, because it's kind of a little bit of an issue here, debacle. I'm trying to figure this one out. So with the surprise retail sales recently, as electronics being the number 2 consumer most purchased, also back to school and college shopping along with economic and inflation data this week has a little bit of AI exposure and an earnings call on Thursday. Am I going to get the bear button, the hold call, or the bull button from Dell Technologies?
All right, I'm going to stick my neck out here. I usually don't like to do that, but I'm going to say that I believe Michael Dell. The stock is down from 179 to 111. That seems to be a decent risk reward. I'm saying you can buy it. Wow, I am out there. How about Ethan in California? Ethan.
Hey, what's up, Jim?
Not much. How about you, Ethan?
How you doing?
I'm all right. I got a toothache, actually. I don't know how to get it fixed. I can't fix it myself. Go ahead.
No, toothache. That's not good.
No, I'll get some of that Ambisol or something after the show. I'll order it from Amazon. I'll be there today. Go ahead.
In terms of Lucid, it has a nice little run recently. What do you think about it reaching?
I think you should sell Lucid. You know what? I'm tired of these stocks that are companies losing too much money. I got Rivian that I'm backing, and I'm already out there on that one. So, and that, ladies and gentlemen, the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, own it, don't trade it. What you need to know ahead of Nvidia's reports. Next.
When I renamed my dog Everest after Nvidia back in 2017, at a time when the stock was $3 and change, who knew it would rally more than 3,000% over the next 7 years? Many greeted my name change as a stunt. Even as Everest, a rescue mutt who loved me dearly, dutifully answered Nvidia, whether I had a Blue Buffalo-filled steel cup or the more popular T-bone in my hand. That boy would eat anything, including raisinettes stolen from my backpack, something that produced a midnight run to the vet. It wasn't a stunt, though. I renamed my dog out of pure frustration. I'd been to Nvidia. I'd seen the future. I was having trouble getting people excited as I was about this great company. I couldn't figure out a better way at least, to catch people's attention so they could see it too. What I'd seen was a preview of where things might be headed. Of course, at that time, Nvidia's focus was on video games with lifelike graphics. Jensen Huang, the redoubtable CEO, had shown me stormtroopers from Star Wars, along with their counterparts from a video game based on Nvidia chips, and I could not tell the difference. Since then, I've made additional trips to Nvidia where it became clear that artificial intelligence was superior to human intelligence in many ways. We don't truly know how to use it yet, which is a common problem with Jensen's designs. But ChatGPT changed everything and made it clear that we weren't going back. By the way, ChatGPT was a use case from way back in 2016 when Jensen met Sam Altman, OpenAI's founder, and delivered him the first ever GDX, the platform needed to make all the generative AI magic. It truly did change everything. It was the invention that really got things rolling. You see, so much was out there, so much was possible that I simply couldn't stand the idea of you missing out on NVIDIA. You! For me, the risk was failing to make people understand the sheer wonderment of this technology, hence the name change Everest to NVIDIA. Jensen liked the story enough that he gave me, a dog tag for NVIDIA. He could get in the building, not me. To be sure, I still think there are many other uses that only Jensen has thought through, and the rest of us will only realize in years to come because we're just kind of not as smart as Jensen. This week, NVIDIA, the company reports. Of course, this is a different NVIDIA, a company everybody knows, with a stock that everybody loves, and Wall Street expects huge numbers come Wednesday. I certainly think we need to see a meaningful guide up if the stock's going to act well. We have to find out how late this next iteration of their high-end chips might be, and how well they're selling, and what's on tap for the one after this. That's called Rubin. Ben writes this from Melius, that's the best analyst on NVIDIA, told me, quote, the key is hearing commentary on the Blackwell product cycle for next year and Rubin for calendar 2026 that makes the average investor realize we are just getting started and street numbers for those years are very conservative, end quote. He went on to say, quote, this is the key and will allow the stock to be bought on any dip related to immediate term expectations, end quote. He reminds us how big all this is and that the use case is more than justified the stock's valuation. I think the Ben's dead right. He expects a good quarter, perhaps a $2 billion beat, but the forecast needs to be $2 billion better than that, expected to get truly much better over the years. Now, I have no idea if that's doable, but if NVIDIA delivers another huge beat, it could make the stock go higher. That said, I'm more in the camp of being ready for a pullback because it feels like everyone owns this one already. That really works out. No matter. My view is simple. Long term, I believe in the use cases for NVIDIA's chips. I believe in the new industrial revolution as articulated by Jensen Huang, and that's why I say own it, don't trade it. At the end of the day, I didn't rename my pet after just any company. I'd like to say there's always a bull market somewhere. I promise I'll find just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.